Welcome to The Explainer. Today, we're demystifying the stock market's incredibly wild week that just wrapped up on Friday, June 12th, 2026. And wow, we've got a lot of ground to cover today. We're talking everything from historic Wall Street debuts to massive geopolitical shifts that are sending shockwaves through global commodities right now. So, let's break down the complex, invisible forces that are driving your portfolio. Okay, let's dive into this, because the central question on every trader's mind right now is exactly this. What actually drove this week's wild market rebound? I mean, if you were watching the tickers on Friday, you saw this massive green wave just wash across the major indexes. But, the market is a highly sensitive instrument, and it's reacting to a very specific cocktail of global events, corporate megatrends, and shifting sentiment. To really understand the setup, we first have to look at the broad market outcome on Friday before digging into what actually caused it. Grounding ourselves in the data here, on Friday alone, the S&P 500 ticked up 0.5%, the Dow added 0.7%, and the tech-heavy Nasdaq composite gained 0.3%. But honestly, the real standout was the Russell 2000. It rose 0.8% on Friday, capping off a super impressive 3.9% gain for the week. And when we zoom out to the yearly climbs, the picture gets even more fascinating. The S&P is up over 8.5% for the year, the Nasdaq is up 11.4%, and the Russell 2000 is just leading the pack, up an astonishing 18.6% year to date. I mean, that represents serious, sustained bullish momentum. But to figure out why Friday specifically saw such a lift, we have to look away from the exchanges. Let's move to and see how this builds, because we have to look at the invisible macroeconomic and geopolitical forces driving those index numbers. Now, what's really interesting about this next point is that a negative number was actually the hero of the day for stock investors. Negative 3.4%. That represents the sharp drop in Brent crude oil prices on Friday. You see, when oil prices drop significantly, it often acts like a pressure release valve for the broader market. Cheaper oil means lower costs for businesses and consumers, which helps ease those persistent inflation fears that, frankly, keep traders awake at night. But oil doesn't just drop by over 3% on a whim, right? There was a very specific catalyst for this. The major macro catalyst driving that oil plunge was the growing hope for a U.S.-Iran peace deal. According to reports, an agreement could end hostilities and, crucially for the markets, get Iranian oil flowing freely into the global supply chain again. That anticipation of increased global supply is exactly what sent Brent crude tumbling. Meanwhile, as traders were digesting that geopolitical news, their eyes were also locked on the calendar. June 16th and 17th marked the very first Federal Reserve meeting led by the newly appointed chairman, Kevin Warsh. Anytime there's new leadership at the Fed, the market pays hyper-close attention to every single word spoken to gauge the future direction of interest rates. Furthermore, the markets are actively pricing in domestic political headlines heading into the weekend. Traders are closely monitoring recent comments made by Donald Trump, as well as the court-ordered removal of his name from the Kennedy Center facade. Shifting political winds can absolutely impact regulatory expectations and sector outlooks, so Wall Street algorithms and human traders alike are treating these developments purely as market-moving variables, keeping a very close watch on how these headlines evolve over the weekend. All right, shifting gears from grounded macroeconomics, let's look at the highly visible corporate megatrends, specifically the space race. 19.2%. That is how much SpaceX stock surged above its initial pricing on its very first day of trading. This isn't just a successful IPO. This is a historic statement of immense investor demand. Despite some of the choppiness we've seen in the markets recently, this incredible closing pop suggests that Wall Street still has an absolute insatiable appetite for AI-related and deep tech stocks. Institutional and retail investors alike just clamored to get a piece of the space economy megatrend, immediately catapulting SpaceX into the ranks of the largest public companies on the planet. And this brilliantly illustrates the sheer scale of wealth creation we are witnessing right now. Thanks to that staggering 19% opening day surge, Elon Musk has officially crossed a threshold no human being has ever crossed before. He has become the world's first trillionaire. It's a milestone that's honestly almost difficult to comprehend. The valuation of SpaceX, combined with his other ventures, has pushed his net worth into a category entirely of its own, literally redefining the upper limits of modern corporate wealth. To understand exactly how he achieved that trillionaire status off this IPO, we just have to look at the ownership structure. Musk managed to retain a massive 46% stake in SpaceX. Think about that for a second. It is exceptionally rare for a founder to take a company public at this astronomical valuation and still hold nearly half of the entire equity. The remaining 54% is dispersed among all other shareholders combined. Because he held on to such a massive slice of the pie, that explosive Wall Street valuation translated directly into hundreds of billions of dollars added to his personal ledger in a single afternoon. Wild. Moving into our final segment, let's cover the rapid-fire moves in AI, institutional buying, and some looming legal battles facing tech giants. So, the crucial point is how the major players reacted amidst all this chaos. Cathie Wood's ARK Invest made a massive statement, snapping up 3.3 million shares of SpaceX right out of the gate on IPO day, cementing her firm's belief in the space megatrend. Elsewhere, we saw decidedly bullish moves from companies like Viking and Bloom Energy, which really helped lead the broader market rebound. However, despite the SpaceX euphoria, the broader artificial intelligence sector actually saw a mixed performance following some really sharp whipsaw swings earlier in the week. It kind of shows that investors are starting to become a bit more selective about exactly where they park their AI capital. We're also seeing a fascinating dichotomy in the modern tech sector right now. On one hand, you have the unbridled, limitless optimism of SpaceX's Wall Street success. But on the other hand, traditional tech giants are facing what analysts are calling their big tobacco moment. A horde of looming lawsuits are threatening the core business models of platforms like Meta and Google. These legal battles are targeting the critical legal shield that protects these companies from liability for the content posted by their users. If these lawsuits succeed and that protection is stripped away, it could fundamentally alter the economics of the internet as we know it. It's a stark contrast, right? Hardware and space exploration reaching new heights, while social media and search algorithms face existential legal threats right down here on the ground. Which brings us to the ultimate question we need to be asking ourselves as we close out this explainer. How will these sky-high AI and space race valuations actually hold up as Kevin Warsh and the new Federal Reserve leadership officially take charge next week? We have a market fueled by geopolitical optimism and deep tech enthusiasm, heading straight into a highly anticipated central bank meeting that could completely rewrite the rules on interest rates. It's the classic clash of micro megatrends versus macro monetary policy. I highly recommend keeping a close eye on those Fed statements on the 16th and 17th because they will undoubtedly set the tone for the rest of the quarter. Thank you so much for joining me to unpack all of this. Keep learning, stay focused, and I will see you in the next explainer.